The market just took a tumble, but your money doesn't have to. In times of crisis, smart strategies can shield your wealth and even uncover new opportunities. From building a robust emergency fund and sticking to a diversified portfolio, to using cash reserves for buying dips and deploying tools like bond ladders or hedging with T-bills, you're not helpless, you're proactive. In this video, we'll break down exactly what steps to take, why they matter, and how to stay calm, focused, and resilient when markets crash. Today we will talk about how to protect your money during a market crash, what you need to know. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understand why market crashes happen and prepare mentally. Before we get into strategies to safeguard your portfolio, it's crucial to first appreciate why market crashes happen in the first place. A market downturn typically occurs when prices of stocks, bonds, and other assets suddenly and broadly diminish in value, often triggered by a shock. That shock might be an economic downturn, a geopolitical crisis, a collapse in commodity prices, or even something unpredictable like a health crisis. Market drops are a reflection of fear and panic selling, not a careful reassessment of companies' future profits. This context matters because when you view a market drop through a clear, non-emotional lens, you're less likely to make irrational decisions, such as selling at a bottom, and more likely to implement strategies to protect your portfolio. The first key to protecting your wealth during a downturn is staying calm and focusing on fundamentals. That means ignoring sensational headlines and trusting your financial plan. 2. Diversify your assets to reduce risk. A well-diversified portfolio is your first and most effective line of defense against a market downturn. Diversification simply means keeping your portfolio from being overly exposed to a single asset, sector, or geographic area. If you're all in on technology stocks, for example, a downturn in the tech sector could wipe you out. But if you own a mixture of stocks, bonds, real estate, gold, and cash, a drop in one area will be cushioned by stability in another. Bonds typically outperform stocks during market downturns, and gold often holds its value when equities falter. Furthermore, adding some defensive stocks, companies that produce essential products like food, pharmaceuticals, or utility services, can help stabilize your portfolio. Large, well-established businesses, sometimes called blue chips, with strong balance sheets and healthy cash flows are less prone to dramatic drops and often pay reliable dividends, adding income when prices are falling. 3. Keep some cash or liquidity on hand. Having a portion of your portfolio in cash or liquid assets, typically 5 to 10%, can be a lifesaver during a downturn. Cash not only dampens portfolio volatility, but also lets you capitalize on buying opportunities when prices are depressed. If you have cash available, you can buy strong companies at a discount, adding valuable holdings at prices you may not see again for years. Furthermore, having cash reduces the pressure to sell assets at a loss to fund expenses. Maintaining an emergency fund of at least 6 to 12 months of expenses in a liquid account is a key principle of financial stability. Ideally, this fund should be kept separate from your portfolio, in a high-yield savings account or a money market fund. That way, you're not forced to withdraw from your portfolio during a downturn, and you have peace of mind that your lifestyle isn't immediately at risk if your portfolio drops in value. Liquidity in this context is a powerful tool, a buffer against panic selling and a war chest for future buying opportunities. 4. Stick to your long-term plan and rebalance. When markets become volatile, it's very easy to be influenced by the emotion of the moment, fear, panic, and irrational selling. But protecting your portfolio isn't about reacting impulsively. It's about staying the course and following your long-term plan. If you have a well-thought-out financial plan and a portfolio designed to match your goals and risk tolerance, a downturn should be an expected part of your journey. This is a perfect opportunity to rebalance, selling a small portion of assets that have performed well and adding to those that have dipped, in order to bring your portfolio back to its original allocation. Rebalancing enacts a discipline of buy low, sell high, a powerful approach to protecting and growing your portfolio over time. Importantly, this should be done in a systematic, unemotional way, not in a reactive rush, and preferably according to a set schedule, such as once or twice a year, or when your portfolio strays more than 5% from its target allocation. 5. Reduce risk by reallocating to less volatile assets. As you approach retirement or a key financial milestone, you should consider reducing portfolio risk. Market crashes can undermine your portfolio's ability to fund future goals, and you may not have years to wait for a recovery. That's where gradually shifting toward less volatile assets comes in. Bonds, particularly high-grade or government bonds, typically outperform stocks during downturns and can act as a stabilizing force. Certain instruments, like certificates of deposit (CDs) or money market funds, can provide a small risk-free return. Furthermore, adding assets like Treasury inflation-protected securities (Type S) can help protect against inflation and downside risk. Ideally, this de-risking process should be a gradual, well-planned move made before a downturn, not a reactive change made after prices drop. For those close to retirement, financial planners often recommend following a glide path, slowly reducing portfolio risk by shifting toward more bonds and cash-like instruments, starting 5 to 10 years in advance of your retirement date. This lets you avoid selling stocks at a low just when you need the funds. 6. Take advantage of market volatility. A downturn isn't just a time for damage control, it's an opportunity to find great companies at a discount. Market drops often push prices well below their intrinsic or fair value. That means you can buy strong businesses, companies with solid balance sheets, durable competitive advantages, and healthy profits, at prices that reflect panic and fear, not their true worth. Some strategies to consider during a downturn include dollar cost averaging, which involves investing a fixed amount of money at regular intervals regardless of price. That lets you buy more shares when prices are low and fewer when prices are high, effectively reducing your average cost per share over time. 7. Monitor your risk tolerance and stick to your plan. Your ability to handle losses. Your risk tolerance, it is subjective and evolves over time. Market drops are a real-world test of whether your portfolio's risk level is appropriate for you. If you find yourself losing sleep, worrying excessively, or making impulsive trades during a downturn, it may be a sign that you have more risk than you can handle. This is a perfect opportunity to reassess your portfolio's risk, reflect honestly on your goals, and make measured adjustments if necessary. But make sure those adjustments are thoughtful and not reactionary. Ideally, you should match your portfolio's risk to your financial goals, time horizon, and ability to absorb losses. That might mean adding more defensive assets or trimming positions in riskier stocks. Whatever you do, avoid letting fear dictate your decisions. Instead, align your portfolio with a well-understood, realistic view of your financial future. 8. Staying grounded during market volatility. Ultimately, protecting your portfolio during a market downturn comes down to having a well-laid plan and trusting it when fear is pervasive. Market drops are a normal, and sometimes dramatic, part of investing. But the greatest investors are those who stay calm, follow their strategies, and view downturns as opportunities instead of disasters. Your portfolio should reflect your goals, your risk tolerance, and your time horizon. It should be adequately diversified, filled with high-caliber assets, and supported by a cash buffer to absorb short-term needs. Furthermore, regularly rebalancing and adding to holdings when prices are weak can put you in a strong position to outperform when markets eventually rebound. Instead of trying to avoid downturns, which is nearly impossible, aim to prepare for them. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.